Hey everybody, welcome to Chapter 4. This is Accrual Accounting Concepts. I know that's hard to say 3 times fast and just a little confusing, which we'll find out here in a minute. But I promise you that with a little bit of effort on your part, we'll get through it. My daughter once bought me a button that said, "Accounting, it's an accrual world," which I know is lame, and yet, well, I like dad jokes and I like lame accounting jokes, so I appreciated it anyway. Anyway, so let's talk about accrual accounting concepts. So there's the learning objectives for the chapter. You can take a look at those. These are the things we're going to try to figure out together this chapter. There's the preview, how it breaks down. Again, you can take a look at those. I won't bother reading them all off to you. The nice thing about video is you can pause it and look at them as long as you want. They're also in your book. All right, so here's what happens. As accountants, we have to sort of create an artificial series of periods to record accounting information. If you think about it, all time is kind of an artificial construct. God's probably not limited to months and years and all of those sorts of things the same way we are. And so we have created artificial periods of time to help us keep track of life. When the earth goes around the sun, we call that a year. When the earth revolves once, we call that a day. And so we've carried that over into accounting. Generally speaking, we work in periods of months, quarters, and years. There are exceptions to that, but those are the normal periods that we break accounting information into. The second thing we need to recognize is something called the revenue recognition principle. That is, there's always this question of, when do I say that I have earned revenue or incurred an expense? If somebody pays me now for a service I will perform in the future, did I earn the revenue now because I received cash, or do I earn the revenue when I actually perform the service or deliver the product or goods to them? And so in accrual accounting, which is the recognized by GAAP, Generally Accepted Accounting Principles, way of doing accounting, we are going to recognize our revenue when we perform the service or deliver the good. Their wording on the slide is revenue is recognized in the accounting period in which the performance obligation is satisfied. I think that's confusing. Just think of it this way. We recognize revenue when we have earned it, and we earn it either through delivering goods or services. Okay? All right, so here's their illustration. Conrad Dry Cleaners cleans clothing on June 30th, but customers do not claim and pay for their clothing until the first week in July. When did they earn the revenue? The answer is they earned it in June, because that's when they provided the good or service. So what we're going to do is, when we've earned the revenue, we'll record it in June as an account receivable, meaning the customer owes us payment, and a service revenue. Then in July, when the customer pays us, we'll show that we have cash increasing and our accounts receivable account going down. So how do we recognize expenses? Well, we match our expenses with our revenues. Why? So that we can understand how much money we've really made. Right? In business, we know that we're there to make money, but making money costs money. And so that we can figure out how much money we've made, we want to match the expenses, or the cost of earning revenue, with the revenue that we've earned. So here's their big slide to help you understand what all that means. It's a little confusing unless you read it carefully. But really, it kind of goes over everything I just said in review. We're assuming periodicity, meaning that accounting is broken into artificial time periods. We are assuming that revenue and expense recognition will be in accordance with GAAP, which is that revenue is recorded when it is earned, during the period in which it's earned, and expenses are matched to the revenue of the period. So that's what we're going to be talking about for the rest of this chapter. All right. So again, Another restatement here, transactions recorded in the periods in which the events occur, revenues recognized when the service is performed, even if cash is not received, expenses are recognized when incurred, even if cash was not paid. Maybe that's an even clearer restatement of what I just said. That's what we do in accrual-based accounting. In cash-based accounting, they recognize revenue only when the cash is received, and expenses are recognized only when cash is paid. These are prohibited under GAAP. The IRS will actually allow certain businesses to still use cash-based accounting, especially very small businesses, but pretty much everybody uses accrual-based accounting. All right, so here's an example of why we bother with all this trouble of accrual-based accounting. Here's Fresh Colors Paint. It's a large building in 2013. In 2013, it incurs and pays total expenses, salaries and paint costs of $50,000. It bills the customer $80,000, but it does not receive payment until 2014. Maybe they did the job in December, right? It could even just be a few days really between finishing the job and getting paid. But so if we go on an accrual basis, you'll see that in 2013, when we did the work, we recorded the revenue of $80,000 and the expense of $50,000, and we have a net income of $30,000 for 2013. And in 2014, we have no revenue, no expenses, no net income. If we use the cash basis, we record the expenses when we spend the money in 2013, so it shows a net loss of $50,000 in 2013, and then we record the revenue when we receive it in 2014, and it shows a net income of $80,000 in 2014. Well, that's confusing. It doesn't really tell the financial picture. And since that's what we're really trying to do is communicate accurately what's going on, the accrual basis really does that for us. That's why accrual accounting. All right. So, as you can imagine then, this is going to make for some challenges. We may have received money before we've earned it. And so we're going to have to make what's called an adjusting entry to recognize when we earn the money. We may have paid bills before we've actually incurred the expense. Again, we'll have to make adjusting entries. So we're going to talk now about adjusting entries. Again, you can read what's on there, but I'm going to jump into what they are. So they're broken into 4 types, okay, 2 categories of 2 each, so 4 total types of adjusting entries. The first are called deferrals. Those include prepaid expenses. Remember we talked about that last chapter, that some expenses we pay before we incur them. A good example would be insurance, where we pay for a whole year of car insurance or 6 months of car insurance, but we haven't really incurred the expense of a year's worth of car insurance. So what we have to do is we have to recognize each month that we have used up, or consumed is their word here, some of that expense. Okay, so if I pay $1,200 for a year's worth of insurance, then really each month I'm now using up or consuming a month's worth of insurance. And so I have to recognize that in my books. Unearned revenues, this is where the cash is received before the services are performed. So if the customer pays us in advance, I rent storage units, that's one of my businesses. So if a customer pays me for a full year's worth of storage usage, $480 for a year, then really when they do that, my cash goes up and a liability goes up because I owe that rental to the customer. And then each month, each period, I have to recognize that a portion of that liability that I owe the customer has now been satisfied because I've given them a month's use of the unit, and a portion of that revenue has been earned because I provided goods or services for the month. So those are the deferrals. And then the accruals. So in accrued revenue, revenues for services performed but not yet received in cash are recorded. So sometimes we perform the service ahead of time but don't receive cash until later. And we've got to record that at the end of the period. All of these adjusting entries occur at the end of the period, where we're looking over the period and saying, are there any expenses or revenues that I have earned that I have not yet recorded? Or vice versa, that I have recorded but have not yet earned, right? And then the accrued expenses. Expenses incurred but not yet paid in cash are recorded. So that happens a lot when we owe interest on something, or when our employees are working They may work for a week, but we're not going to pay them until the next payday. Well, we've got to show on our financial statements that we've incurred the expense of a week's worth of work, even though we won't be paying them until the next period. I'll give you some examples, hopefully that will clarify. So there's a trial balance. We learned about those in Chapter 3. And each account, we would look at them and analyze them to see if there are any adjusting entries that we have to make. So we mentioned the deferrals, prepaid expense, and unearned revenues. Again, a prepaid expense is a payment of cash that's recorded as an asset before service because the service or benefit will be received in the future. They often occur with, and there's the bullet points, insurance and rent I think are the most common. And then there's another form of that which we'll talk about that involves depreciation. All right. You can read that. Let me get into the example. All right, so here's what our adjusting entry will look like. Remember, with a prepaid expense, what we did is we recorded an asset when we prepaid. So if we prepaid insurance, then we recorded an asset called prepaid insurance. And now, each month, we are using up some of that prepaid insurance. So we have to decrease the asset and increase the expense. That's the adjusting entry. Here's an example. Sierra Corporation purchases supplies that cost $2,500 on October 5th. They record the purchase by increasing the asset supplies, and they show a balance of $2,500 in the supplies account. Then at the end of the month, they count up all the supplies they have on hand, and they realize they only have $1,000 worth of supplies. That means they must have used up some of that asset during the period. So they enter an adjusting entry to decrease the amount of the asset, supplies, by $1,500 and to increase the amount of supplies expense. That accurately shows how many supplies they used during the period. So there's our journal entry. All right, another one. On October 4th, Sierra Corporation pays $600 for a one-year fire insurance policy. Coverage began on October 1st. Sierra recorded the payment by increasing or debiting an account called prepaid insurance, which is an asset. And their cash would have gone down, right, when they paid for it. Then at the end of each month, they have to do an adjustment to show that they are using some of that prepaid expense, the asset is going down, and that they are claiming it as an expense. So what they do is they take $600 for a full year's worth, divide it by 12, and that gives them a $50 monthly expiration or usage of the insurance. So the adjusting entry will be the asset prepaid insurance decreases by $50, and the expense, insurance expense, increases, or is debited $50. There's the adjusting entry. All right, so similarly, we have depreciation. Depreciation can be a little bit confusing because we always think of it as using up an asset, and it kind of is what we're doing, but really what we're doing is we're matching the cost of an asset, such as a building or equipment, over its useful life. So we're saying, hey, if I bought a building for $100,000 and that building's going to last for 30 years, I can't just claim the expense for the whole $100,000 on the first day. That's going to throw my books all off. It's going to look like that asset only generated value for me for that 1 month. Instead, what we do is we divide up the value of the building over its useful life. And then we take an expense or use up the asset over its life. All right. This thing at the bottom, this last bullet point is an important one. It says depreciation does not attempt to report the actual change in the value of the asset. In other words, we don't know if the building is growing in value or decreasing in value. We just have to claim an expense for a portion of the asset's value, and we spread that expense out over the asset's life. All right, so here's an example. Assume the depreciation on their office equipment is $480 a year. So we divide that by 12, and that comes out to $40 a month. So rather than directly impact the asset, when we're doing depreciation, we use a special account called an accumulated depreciation account. Sometimes this account is called a contra asset because it reduces or offsets the value of the asset account that it's associated with, in this case, equipment. So we do the entry to accumulated depreciation on the equipment, a credit of $40, and a debit to depreciation expense. All right, and then on our balance sheet, what it's going to look like is the asset, each asset will have an associated accumulated depreciation account and will be listed just as you see in the illustration, where there's the equipment less any accumulated depreciation to give you a net value of the equipment. All right, so there's our summary of the adjusting entries for prepaid expenses. Give some examples. The reason for the adjustment shows that we've used up the assets. And the adjusting entry almost always looks just like that, a debit to expenses and a credit to the asset. So how about unearned revenues? Remember, unearned revenues means when we receive cash before we earn the revenue. So what we do is we record a liability and we record the asset increasing when we receive that money. Think of it, if someone pays me in advance, then my cash goes up and I owe them something. They often occur with rent, subscriptions, things like that. All right, so our adjusting entry is going to record the revenue that we're earning now, and it's going to reduce the amount of liability that remains. That's the adjusting entry. So it's going to be a debit to a liability account and a credit to a revenue account. There's a graphical representation of the same thing. All right, and now an example. Sierra Corporation received $1,200 on October 2nd from Knox for guide services for multi-day trips expected to be completed by December 31st. Unearned service revenue shows a balance of $1,200. Okay? Remember, even though it has revenue in its name, it's not a revenue account. Unearned service revenue is a liability, money that they owe. They either owe the $1,200 back to Knox, or they need to deliver the service to them, and then they'll have earned the revenue. All right, from an evaluation of Sierra Company of service Sierra performed for Knox during October, the company determines that it has earned $400 during October. So they're going to do an adjusting entry to decrease the amount of liability, right? They no longer owe $400 to them because they've earned it, and then to claim it as revenue. So they will debit the unearned service revenue liability account and credit the service revenue account. There's the summary for unearned revenues. All right, adjusting entries for accruals. Remember, we have revenues earned or expenses incurred. That's what we're doing with accruals. So accrued revenues. These are revenues for services performed but not yet received in cash or recorded. So the adjusting entry results in our revenue being recorded and the cash receipt. Before the cash receipt. Right, so let's take a look at one. Serves two purposes. It shows the receivable exists and records the revenues for services performed. Remember, this is where we've earned the revenue but have not yet been paid. So that's going to be a debit to our asset account, and almost always that asset account is going to be accounts receivable. Because if we had received cash, we wouldn't have to do the adjustment. It would show the cash, we'd be good. And the other adjustment will be a credit to our revenue account. Remember, that's an increase to both accounts. All right, so here's our example. Sierra Corporation performs guide services for $200 that were not billed to clients before October 31st. Happens all the time in companies. You get down to the end of the month, you say, oh, we performed these services, now we've got to bill them out. So we're going to do an adjusting entry to increase the amount that is owed to us, which is an asset called accounts receivable, and to increase the revenue. Why? Because we've earned the revenue. So we'll have a debit to accounts receivable and a credit to service revenue. There's a summary. All right, and now we'll talk about accrued expenses. These would be expenses that we've incurred but have not yet paid for in cash. Okay, I mentioned this happens a lot with salaries, pretty much at the end of every month, there'll be some amount that our employees have earned, but we have not yet paid them because we won't pay them till the next payday. And it happens with taxes and interest a lot too. If you think about it, if we sell stuff all month, then we've incurred sales tax expense that we're going to have to pay to the government at some point in the future, but we haven't yet paid it. So it records the obligation or the liability that we owe and records the expense. But again, you see there's no cash because we haven't paid it yet. So there's the graphical representation. A debit to expense is an increase to the expense, and a credit to the liability, which is also an increase to the liability account. Here's the example. Sierra Corporation signs a 3-month note payable in the amount of $5,000 on October 1st. The note requires Sierra to pay interest at an annual rate of 12%. So the assumption here is that we're going to pay the principal and the interest back when the loan is due in 3 months. So each month we're incurring a cost of borrowing this money. And we could figure that out, how much it is, by taking the face value of the note, which is $5,000, times the annualized interest rate, which is 12%, times the time. In this case, the amount of time is 1 month, or 1/12. Okay? The reason we do it that way is because the interest rate is expressed in an annualized rate. So if we took the face value times the interest rate, that would tell us how much interest we would incur for a year. We need to figure out how much interest we'll incur for a month, so we're going to take 1/12 of the amount for a year. If we were figuring out 3 months, a quarter's worth, we would do 3/12. Okay? So interest in this case is $50. That's how much interest expense we've incurred for using this borrowed money for a month. So we're going to do an adjusting entry to increase the expense, which will be a debit to the expense, interest expense, and to increase the amount we owe, which will be a credit to the interest payable account. Another example, they last paid salaries on October 26th. Their next payday won't occur until November 9th. The employees receive total salaries of $2,000 for a 5-day work week, or $400 per day. That means if we go from, we paid on the 26th, so we owe for the 27th, just for the work day. So for the Monday, Tuesday, Wednesday, 29th, 30th, and 31st, 3 days. So if it's $400 per day, we multiply that by 3 days, we owe $1,200 at the end of the month. So we record that. If we didn't record this, then our income statement wouldn't show that we'd incurred this expense during the month. So it would be off, okay? So what do? Salaries and wage expense, debited $1,200. Salaries and wages payable, credited $1,200. There's the summary for accrued expenses. So those are the 4 types of adjusting entries. I suggest you become familiar with how they work, and you'll get some experience with them in the homework assignments. There's a summary of all those relationships. I won't reread them to you. You can pause it and look at this longer if you want. You can also find it in the book, illustration 4-23. All right, so after we've done these adjusting entries, now we're ready to make an adjusted trial balance. Remember, the trial balance showed the balance of all the accounts. Now we've made adjustments, so we've changed that. So the adjusted trial balance will just be the new balances. Remember, our supplies on the original trial balance were $2,500, but we recognized that we used up $1,500 worth of supplies. So now the balance is $1,000. And there's an example of the adjusted trial balance. What's cool is once we have an adjusted trial balance, it is super simple to make all of our financial statements right off of the adjusted trial balance. If you take a look at it, you'll see down there at the bottom, all of the accounts in red, those flow to the income statement. Pretty much it just comes straight over. That gives us a net income. So then we can take our retained earnings that we had, we can add in the net income, which we just figured out from the income statement. We can subtract the dividends, which are there on our adjusted trial balance, and that will give us our new retained earnings. And then we can take all of the accounts, the top accounts there now that are in red, transfer them straight over to the balance sheet, take the retained earnings off of the statement of retained earnings, and boom, we've got a balance sheet. So it's really cool. Once you do that trial balance, do the adjustments and do the adjusted trial balance, then you can just very easily create the financial statements. All right, so this just talks a little bit about quality of earnings. As you can imagine, if the company can kind of have a little leeway in how they recognize revenue and expenses, they can make their financial statements confusing for anybody who doesn't understand the company well. I think I mentioned that before, that the Waste Management Corporation did this with the way they were depreciating some of their assets. Other companies have done things such as delivered goods or services to customers during one period, knowing that the customers didn't want them, only to receive them as returns in the next period, but they showed those delivered goods and services as revenue on the expense on the income statement in the period, which made it look like they were doing better than they really were. And so our quality of earnings means that we want the company to provide full and transparent information to everybody involved. Anyway, so that's what that means, and they'll probably have something about that in the homework. All right, so at the end of the accounting period, we have to close the books, it's called. And what that means is, if you think about it, remember the income statement tells the story of the company during a period. So from the beginning of October to the end of October, how much revenue do we make and how much expenses did we incur to make that revenue? And so what's our net income? But the balance sheet, it's always as of a certain date, because those accounts just have a certain value at a given point in time. Balance sheet accounts are also called permanent accounts, because they don't have to ever reset back to zero. They just tell you what the value is of that account right now. But income statement accounts are called temporary accounts, or sometimes they're called nominal accounts. And what they do is they tell us how much revenue, how many expenses, how much dividends we've had during a certain period. So at the beginning of a new period, we need to return them to zero. Okay? That way we have zero revenue, zero expenses, zero dividends at the beginning of the new month. And the way we do that is we transfer them all to a permanent account, and that permanent account is retained earnings. Okay? So closing the books is the process by which we transfer the revenue and expense accounts and the dividend accounts to retained earnings. And here's how it happens. The revenue account and the expense accounts are closed to an account called income summary. The dividends are and then income summary is closed directly to retained earnings. Dividends is also closed directly to retained earnings. Let me show you how this would work. All right, so you'll see here the company has a balance of $10,600 in its service revenue account. If you think about it, revenue would have that balance on the credit side. So to close out our revenue, we're going to debit the service revenue account $10,600. Now the account will have a balance of zero. When we do the entry, we always have to do it. You can't just do one entry, right? It's dual entry. So if we debit service revenue $10,600, then we're going to credit income summary. This is a special account we use just for closing the accounts. We're going to credit income summary the same $10,600. Then we can see all of our expenses. Remember, they would have debit balances because that's the normal balance for an expense. So we will credit those accounts, their full balance, so they now have zero balances, and we will debit income summary for the same amount. Then our income summary account will have a balance. If we credited $10,600 and we debited $7,740, then the income summary will now have a balance of $2,860 on the credit side. So we're going to debit that account, $2,860. So now income summary is returned back to zero or closed, and we will credit retained earnings, $2,860. Sorry, I had a brief interruption there. Let's see if I can remember where we were. Okay, income summary would have a balance of $2,860, and it would be on the credit side. So we would debit that account, $2,860, and we would credit retained earnings, $2,860. Remember, the intent is to close all of these temporary accounts back to zero, and then to move them all to the permanent account, retained earnings. Retained earnings, and then we would do dividends. The dividends would have a debit value or a debit balance of 500, and we would credit that account to return it to zero, and credit that or debit that money to retained earnings. All right, so here's kind of a summary of it. So you'll see there's the salaries and wages expense, all the expenses on the left-hand side. They all had balances on the debit side, because that's their normal balance. So we made the credit entries and then credited them to, so we credited those accounts and debited income summary. The revenue account there on the right had a balance of $10,600 on the credit side, because that's where revenues are their normal balance is. And so we debit that account $10,600 and we credit income summary. Then there's a difference of $2,860, so we debit income summary that $2,860 and credit the retained earnings account. Then there was the dividends. It had a debit balance, so we credit that account and debit the retained earnings. That's how we close the books. Everything's taken to zero except for retained earnings, which now has a balance of $2,360. And if you remember all the way back to when we did our statement of retained earnings, you'll have noticed that retained earnings started with zero, added $2,860 in net income, deducted $500 in dividends, and ended up with a balance of $2,360. All right, finally, what we'll do is we'll create a post-closing trial balance, which will in essence just have the permanent accounts on it. It'll have the assets, the liabilities, and the equity accounts. None of the revenue, expense, or dividend accounts will be there because they all have balances of zero now that we've closed it. And we're ready to start a new period with zero revenue, zero expenses, and zero dividends. So here's a summary of the accounting cycle. We start with business transactions, we journalize them, we post them to the ledger, we prepare a trial balance, we journalize and post our adjusting entries, we prepare an adjusted trial balance, we prepare financial statements, we journalize and post the closing entries, and then we prepare and post the closing trial balance, and then we're ready to go back for a new period. That's the process accountants follow. A couple things you should be aware of. Net income does not always equal cash. Remember, we had a net income of $2,860, but that doesn't mean we had that much in cash. We could have had more or we could have had less, because some of the transactions we just talked about, where we received cash ahead of time, in certain circumstances before we earned it, so it wouldn't show up as revenue, but it would show up as cash. And conversely, there might be times when we spent cash but had not yet incurred the expense. So here's an example. You can see, for example, they received cash in advance from a customer of $1,200. Well, that didn't go into revenue because they haven't earned it yet. And then there's the cash received from customers for the services provided. That would show up both as revenue when we compute our net income and as cash from our operating activities. Then we had services provided for cash received previously. So this would be cash we didn't get this time because we'd already earned it before. Anyway, you get my point. They don't exactly match up. So in this case, even though they had a net income of $2,860, they actually received cash of $5,700. All right, and then there's a little appendix here, which I'll go through quickly. Sometimes we use something called a worksheet to figure out all of this stuff I just took you through. It starts with a trial balance. That's the first columns of the worksheet. And then we figure out our adjustments and we just put them in a second column. So there's all the adjustments. Again, this is the information we just did. Then we can use those adjustments to figure out the adjusted trial balance. Then we carry over our income statement accounts. Then we carry over our balance sheet accounts. And we include our net income down there at the bottom. Shows it on the debit side on the income statement and on the credit side on the balance sheet, because that's what's happening. It's the difference between the revenues, $10,600, and all the expenses. And that's going to go to our retained earnings. So it goes on the credit side on the balance sheet. Then we have this little worksheet and we use that to work out the financial statements. Anyway, that is Chapter 4. Good luck with it. This is another challenging one, so if you can, start early on the work. And I hope you have a great week.